Okay, good morning, everybody. It's 11 o'clock. So this week's guest is Ked Watton from Strategic Equity Capital. But before that, as usual, I've got a bit of news to cover. So three things I've pulled out: GCP, Hipgnosis, and Riverstone Credit. And we'll start with GCP. That is the chart says 2019. As you can see, the NAV has been fairly stable all the way through this, but the share price detached from that as the rate started to rise in 2022, and the whole thing went to a quite big discount. Now, I don't really understand the reason for that beyond probably the cost disclosure problem, that there's been sort of net institutional sellers because the yield keeps building and building. And obviously the board has been concerned about this and wanted to do something about it. So it announced a share buyback program back in March last year. And then in the results that they announced in December, they outlined this strategic sort of capital allocation policy, saying it wanted to reduce the equity risk in the portfolio and prioritize the kind of debt, lots of loan investments that it's got, reduce exposure to social housing, which is something that they're saying they don't really like for a while, but they just sort of keeps paying the bills, and also cut on the balance of their revolving credit facility, because obviously the cost of that's gone up. So paying that down will benefit cash flow overall. So the target was to release £150 million and then give 50 of that back to shareholders by the end of 2024. And they were also quite keen to recommit to the dividend at the same time. So that's quite well covered already. It's not something that you need to worry about, I think, in terms of dividend cut. And they're convinced they want to keep paying that this year. And then what happened this morning is they've sold their interest in a wind farm in Scotland, and they're going to get £31 million for that of net cash proceeds. So obviously the value of the farm is more than that. So you can't have a sort of read across in terms of pounds per megawatt to other renewable energy companies. But I do think they got a decent price for it because they sold it at 6.4 premium to the end March valuation. And that will enable them to pay down some of that revolving credit facility balance to go down to £45 million. Now, one of the things that I think has puzzled a few people in GCP is why they've got some equity-like exposures in there anyway, because obviously they're supposed to be making loans. As you can see what happened here, so they made a loan, or they bought a loan from the Green Investment Bank, and then instead of getting that paid back, they rolled it over into an equity-like instrument in July 2018. So since then, the exposure to this project has been through like an equity-like instrument. And so that means it's exposed to things like power prices and inflation and there's all the other moving parts that go into renewable energy. So paying that down reduces the risk associated with this investment and reduces the risk overall in the whole portfolio. So I do think this is the current first step. There's definitely more to come. Obviously, the social housing thing hasn't been tackled yet. But more importantly, I think that 6.4 premium to the end March valuation demonstrates something that GCP has been really labouring, which is that it's really conservative in the way that it values things and approaches the whole running the fund. And that does mean, hopefully, that there could be more uplifts to come in terms of more disposals. So we just have to watch the space on that. Hipgnosis. Obviously, we talked about this last week, and there's been plenty of action since, and you can see the share price chart there. So we were looking last week at a bid of 116 per share, plus the possibility of an extra 2 cents, but it seemed quite unlikely to me because that was sort of predicated on the manager waiving its exit fee. But by Saturday, a whole bunch of media outlets were saying that Blackstone will make a counter bid. And then they firmed that up on Monday, saying they made a proposal for a bid at $1.24 in cash. So it's quite a big jump on the 116. And the board naturally said that if Blackstone made that a firm offer, it would recommend it. And so that was the offer that was on the table on Monday. But on Wednesday, the original bidder trumped that, upping their bid to 125. The 2 cent contribution from the manager had been dropped, So that's a sort of hard 125. And they've now got irrevocables in support of 31%. So that's all great, really. They had to rejig the way that they were financing to get this done. So although it's still being funded with debt from Apollo, they've got a plan now to sell some of the assets to reduce that debt within 18 to 24 months. But we don't really worry about that if we've sold out. Blackstone said, don't do anything. We're thinking what we're going to do next. There is a possibility that it could try and go down this using the manager's call option as a way of getting hold of the portfolio. So it does come down to this. There's a big question that nobody sort of pondered, which is why does Blackstone feel it needs a bid in the first place? Because Hipgnosis Song Management has an option to acquire the portfolio at whatever somebody else is bidding for it. And if that happens, then that probably triggers the compensation payment to the bidder that lost out. So that's going to reduce the amount we get a little bit. But anyway, come back to this thing. So Blackstone could just back HSM to bid for the whole thing and get it at the price that Concord were going to pay, Concord Chorus. And they could have done that at 116 per share. So why go out and bid 124? And it was speculated in the press, and this seems to be the most likely reason, is that they were worried that the board would have grounds to terminate the contract, and then that voids the call option. So that route wouldn't work. So naturally, they were very keen to stress on Wednesday that, or Monday it says, we've looked at the legals around this. We think there's a very good case to defend any attempt to terminate the contract. And we would basically sort of go down the courts and try and force the option. And HSN said the same thing. So there's slightly sort of worry that none of this has been our fault. The managers made a lot. The board's made a lot of allegations against us, and we will vigorously protect our interests. So we don't know what's going to happen next. I mean, all this might happen today, but we could see another counter bid from Blackstone. There's always a possibility we'll see another bidder come in, but I think that's unlikely now. But Blackstone might say, no, we're not going to bid for it. We're going to try and exercise the option. That would lead to quite a big legal tussle, potentially. There are all sorts of scenarios here. I mean, say the board said, oh, well, if we're going to get 125 a share, which is what Alchemy bid, but we'll get it through Blackstone. That's not the end of the world. Then maybe Alchemy might sue. All of this could drag on for a while. So I think it's going to take a little bit of time to get this resolved now, and it just means the whole thing's a bit more uncertain than maybe it was a week ago. But obviously, we are looking at a higher price. Riverstone Credit. I really like this fund, and it's been a great shame it hasn't really worked. It's way too small and traded a big discount for a long time now, and really that was all around COVID. I mean, that's what really knocked it. They could have closed this down again, but it wasn't really doable afterwards, and they never really put the money behind it. I mean, we did pursue them for a long time, saying, can we have a go at trying to market it for you? And they never really happened. And that meant that it couldn't grow, but it's worked. All the way through, it's worked. They tweaked the remit, so it's all focused on providing finance to companies that are trying to shift the dial in the environmental space and sustainability. They've done very well. They've met their targets, more or less, 7.7% per annum since IPO. They've just realised a loan, for example, crystallising 12.8% IRR. because of the rates have gone up, the new loans that they're making at even higher rates again. To my mind, this is a great product, but they built into the structure that shareholders were given an exit opportunity around now, and the board talked to a few of the shareholders, decided that too many would want out, and the new fund and the ongoing fund will be too small. And so instead, they're proposing that the fund is run off and the managed wind down. Part of the problem with this is this specialist fund segment listing, which is, as we've seen a lot of press recently, is making it really complicated for retail investors to invest in these sorts of funds, despite the fact that they're not much riskier than, well, they're definitely not riskier than a whole bunch of individual companies that retail investors have absolutely no problem buying. And it doesn't make any sense to me that they're being locked out with these things. Yes, you might need a bit more education, and yes, it's reasonable to ask whether to make sure that you do understand what you're buying or not. But this sort of nanny state thing about saying just trying to block them out completely, I just think is wrong. But if you could buy it now, does it make sense to buy it now? Most of the portfolios are loans. There's a little bit in equities that might be harder to realise. Most of the loans will be run off. Although the sort of face thing on the tenor of the portfolio is about 1.8 years, they normally expect things to get repaid early, so they're expecting things to get paid back within 6 months and a year. And so they think basically they can turn 90% of this into cash within a year. So on a 12.6% discount, and you're going to keep getting the dividends, it might not be a bad investment, but it's not going to make an awful lot of money. So there we go. I think that's enough from me.